The average American has $8,000 in savings. Warren Buffett has $143 billion. That gap isn't luck. It's not inheritance. It's not connections. And it's not even intelligence. Warren Buffett grew up in Omaha, Nebraska, not Wall Street. He filed his first tax return at 13 and built his first million before most people figure out what a Roth IRA is. And here's the thing nobody wants to say out loud. The reason you're not wealthy yet is probably not what you think it is. In the next 7 minutes, I'm going to break down the 3 real reasons, the ones Buffett himself has pointed to in interviews, shareholder letters, and speeches spanning over 60 years that keep ordinary people broke. Not clickbait, not hustle culture advice, the actual stuff. Here's a scenario. I want you to sit with me for a second. You've got a job, maybe a decent one. You're not blowing money on Lamborghinis or designer handbags. You make your rent, you have a little left over at the end of the month, and yet you don't feel like you're actually building anything. Sound familiar? Most personal finance content will tell you the problem is your morning coffee, your avocado toast, or that you're just not budgeting hard enough. That's not the problem. The real problem is structural, it's psychological, and it's been baked into the way most of us were taught, or more accurately, never taught, to think about money. Buffett said something at the University of Georgia back in 2001 that I think about constantly. He said the most important thing to do if you find yourself in a hole is to stop digging. Simple, right? But here's the twist. Most people don't even know they're in a hole. They think they're just standing still. You're not standing still. Inflation is digging the hole for you. Every single day, your money isn't working. And if you've ever said to yourself, "I'll start investing when I have more money," that belief alone might be costing you hundreds of thousands of dollars over your lifetime. Let me show you exactly why. Buffett's philosophy isn't complicated, and that's precisely why people underestimate it. He spent a lifetime saying the same things over and over, and a lifetime watching people ignore them. So here's how we're going to approach this. I'm going to give you each of the 3 reasons, then show you why that reason is more powerful than it sounds, and then, most importantly, give you the flip side, what Buffett actually does instead, and what that looks like practically in your life right now. Not in theory, not in some idealized future where you're already rich. Right now, in 2026, with whatever you've got. Because that's the other thing about Buffett. He didn't wait. He started with $25. He started with a paper route. He started before he was ready. The solution isn't a secret formula. It's a set of habits and mindsets that compound, just like interest does, over time. Here's Buffett's most fundamental insight, and I want you to really hear this. Most people trade time for money, while wealthy people use money to buy time and assets. Buffett once said that if you don't find a way to make money while you sleep, you will work until you die. Think about what that means. Every dollar you earn and then spend is gone. It did one job. But every dollar you invest in an asset, whether that's a stock, a business, or a piece of real estate, keeps working after you stopped. Now here's where most people go wrong. They hear invest in assets and immediately think they need a lot of money to start. They don't. Buffett started buying stocks at 11 years old with $114.75 saved from his paper route. Not a windfall, not an inheritance, just savings from showing up every morning before school. The practical move right now, before you upgrade your lifestyle, before the nicer apartment or the newer car, is to ask yourself one question. Have I paid my future self first? Even $50 a month invested consistently in a low-cost index fund starts the compounding engine. The engine doesn't care how small it starts. It only cares how long it runs. Let me say something that might sting a little. Most people in their 20s and 30s are using debt to fund their lifestyle. Credit card debt, car loans on cars they can't really afford, buy now, pay later for things they didn't really need. And every one of those debts is an anti-asset. It's negative compounding. It's interest working against you instead of for you. Buffett has been almost allergic to personal debt his entire life. He bought his house in Omaha in 1958 for $31,500 and has lived there ever since, not because he couldn't afford something bigger, but because he understood something critical. Every dollar you spend servicing debt is a dollar that cannot compound. Now, to be fair, not all debt is evil. A mortgage on a home that builds equity, a business loan that generates more than it costs, that's leverage. And used carefully, it can accelerate wealth. But the debt most people carry, that's not leverage. That's a leak. The Buffett move is to get obsessive about eliminating high-interest consumer debt, not tomorrow, not when you get a raise, but now, because your credit card charging you 24% APR is, in reverse, exactly the kind of return Buffett has chased his whole career. You just happen to be on the wrong side of it. Kill the leak, then redirect that payment towards an asset. That one shift, compounded over 10 years, is genuinely life-changing. This is the one they don't want to hear, but it might be the most important. Warren Buffett's actual superpower is not being smarter than everyone else, and it's not having access to better information. His superpower is emotional control. He's famously said to be fearful when others are greedy, and greedy when others are fearful. That sounds simple. It is not simple to execute, because every human instinct pulls in the opposite direction. When markets crash, as they did in 2020 and in 2008, the emotional response is to sell, to protect yourself, to get out. Buffett bought, and he bought heavily. When everything felt safe and markets were at all-time highs, he held cash, sat on his hands, and waited while everyone else chased returns. This is why most people's actual returns are significantly lower than the market's average return, even people who are already invested in index funds. They buy high because everything feels good, and they sell low because everything feels terrifying. They let the news, their gut, and their neighbor's hot tip run their portfolio. The fix is almost embarrassingly boring. Automate your investments, ignore the noise, and play a long game. Set up automatic contributions. Stop checking your portfolio every day. Stop watching finance news for entertainment. Buffett has said he could comfortably go years without checking stock prices, not because he doesn't care about money, but because he trusts the system he's built and understands that time, not timing, is the actual edge. All right, let's bring this together. 3 reasons you're still broke. First, you're trading time for money instead of building assets. Second, you're using debt to fund your lifestyle instead of your future. Third, you're making emotional decisions with a tool that requires discipline. None of this is moral failures. None of this means you're bad with money or that you're behind forever. These are learned patterns, and they can be unlearned. But here's what I really want you to actually do before you close this video. Pick one, just one of these 3 areas, and make one concrete change this week. Open a brokerage account. Set up a $50 automatic monthly transfer. Call your credit card company and ask for a lower rate. Unsubscribe from the finance news that's making you anxious. One thing this week, because the gap between Warren Buffett and the average person isn't genius. It's thousands of small, consistent decisions made over decades. You can start that chain today. If this hit differently than the usual money content, hit that like button. Subscribe if you want more breakdowns like this, and drop in the comments which of the 3 reasons resonated most with you.